the HealthiosXchange webinar on venture philanthropy. My name is Scott Jordan. I am the CEO and founder of HealthiosXchange, which is a premier investment marketplace and crowdfunding portal dedicated exclusively to the global healthcare industry. Healthios is an affiliate of Healthios Capital Markets, a FINRA-registered broker-dealer based in Chicago, Illinois. The agenda for this conference, it'll probably take a good 20 to 30 minutes, but here's the agenda. We're going to be defining venture philanthropy. For most of you probably know what it is, but we're going to take a look at some of the history, a look back. We're going to take a look forward as to where it's going. We'll talk a little bit about Healthios and HealthiosXchange, some concluding remarks, and then, of course, foundation place and the ecosystem that we're building around venture philanthropy. So the concept of venture philanthropy, stems from, venture capitalism, which invests, money from various third-party sources in high-risk areas. A venture philanthropy strategy is unique in that its mission is aligned with philanthropic goals and outcomes, namely new therapies and cures. The standard approach has been demonstrated, has not really demonstrated sufficient results, especially on the early stage companies, and venture philanthropy represents a new model by which patient-relevant outcomes may be more quickly achieved. Let's take a look back on venture philanthropy. So one of the ways the industry is characterized or defined as voluntary health organizations, which include nonprofit charitable organizations, patient advocacy groups, and foundations. And so there was a shift to funding translational research. I mean, that's pretty much the history of venture philanthropy, or the foundation of it, was essentially these long-standing history of providing support for those suffering from disease. So buying, distributing medicine, providing food, offering education, philanthropic goals. So the origins, and then into research, they support the earliest stage of translational research. You can see in the red box there, it's helped to bridge the gap in an area that's really suffered recently in the last 4 or 5 years, what they call the innovation gap. So Healthios, being investment bankers, we've seen this firsthand, where a lot of venture capitalists have gone later stage. But anyway, basically they've plugged this gap, from basic research into commercially viable product candidates, funding efforts to translate initial scientific discoveries into testable clinical stage drug development candidates, biomarkers, and diagnostic tools. When we take a look at the VHO's funding early stage research, there's four points here, and Joyce Nelson with the National Multiple Sclerosis Society. But the drug development costs, as the drug development costs have risen, an increasing number of companies have reduced and halted investment in early stage product candidates in favor of late stage candidates. So the blockbuster mentality of many pharmaceutical companies limits the development of drugs for smaller, more challenging diseases, including orphan drug. The risks are too high for the private sector. The recognition of this reality drove VHOs into venture philanthropy, including foundations. So interesting quote here, right? The tough truth is that the drug development funding system is broken where risk is highest. Venture philanthropists therefore need to get in early where the risks are highest and fund the research that will attract the capital markets later. These two bottom lines exist in tandem because while the IRS requires one, a voluntary organization's donors and constituents require both. Venture philanthropy, you take a look at the growth of venture philanthropy and how it's plugging this innovation gap, and it's massive. And the venture community, the strategics know this, thus the demand for public-private partnerships. But you'll see from 2001, when we were at, I don't know, it looks like about 600 million, you can see that there's been a steady growth curve, peaking in around the 1.3 to 1.4 billion area. And the percent, which is the triangles there, you can see a peak of almost 20% of VC life science funding. So venture philanthropy is playing a vital role here. Okay? So let's take a look forward here. So in the public, the strategics realize the large pharma, when I say strategics, that's what bankers call large pharma, medical device, healthcare services. But when we take a look at the public-private partnerships, there's obviously on both sides of the continuum, you have the strategics knowing that they can benefit from the participation from foundations, and those have grassroots type resources. On the flip side, foundations need strategics for their balance sheet and their ability to get trials completed. So it says here, VHOs are not the only players in the battle against diseases, right? The NIH, academia, and private sector bring strength to the table. Nobody can fund the entire spectrum from the basic research through clinical approval. And we think the same thing with crowdfunding, by the way, which we're intricately involved with, is that crowdfunding alone can't get a therapy to the clinic. So on average, I think the average company raises about in the pharmaceutical area, $49 million over the lifetime. So it's imperative that foundations work with strategics, they, corporate strategic groups, venture capitalists, crowdfunders. Dennis Choi of Emory University, you'll see his quote here: forming partnerships with academia, industry, and government and other VHOs is necessary in order to take a particular therapy all the way. Katie Hood with Michael J. Fox, engaging early in a dialogue with industry was one of the lessons learned, trying to understand what the needs are and what it will take from a scientific standpoint to get industry partners further engaged. And Timothy Coetzee with Fast Forward, while supporting scientific discovery is important, is also important to develop new funding models. So the VHOs in the future, they're going to work hand in hand, the nonprofits and venture philanthropists, with the different various ecosystem participants, which do include strategics, venture capitalists, and crowdfunders, to push drug development and medical device development forward. We think that these are 5 elements of what we see in future venture philanthropy. Number 1, highlights, VHOs will continue to engage with for-profits, so they'll be making investments alongside. The deal structuring, venture philanthropy, there'll be creative deal structures. Obviously, Michael J. Fox, Cystic Fibrosis Foundation, are very creative with the way that they structure their deals, similar to venture capitalists. So they have a double bottom line. One is social good, the other is return. The third major point, partnerships with strategics, exits and licenses. So very close collaborations we see going forward between strategics and partners. Partnerships with capital sources, so follow-on capital. So helping them perform due diligence, etc. Due diligence partners, benchmark due diligence. Once again, strengthen numbers, strengthen resources. Obviously, this has resulted in many successful collaborations, but none bigger than this one. So, cystic fibrosis, Vertex, and the approval of Kalydeco, which was one of the most significant advancements in cystic fibrosis that we've seen in quite some time. We take a look at Healthios, and why is Healthios so interested in this venture philanthropy area? Obviously, other than the growth. Real quickly, Healthios is a Chicago-based investment bank that's traditionally been focused on raising money from venture capitalists for emerging growth companies, private equity capital. And over the last 5 years, we've seen a severe constriction of the industry. Over the last 10 years, the number of VC firms has plummeted by 62%. And the annualized annual funding is actually down even 14%, even with the uptick. So the ability to raise money from venture capitalists is getting harder and harder, and the 2 and 20 model, essentially, many think is broken, because the 2, which is the management fee, obviously incentivizes the funds to raise bigger funds. When they raise bigger funds, they're less apt to go early stage because they can't put enough of their money to work. So that's a problem. On the 20% carry, that can be very, very tough on investors. So that's why the average, by the way, the average venture capitalist fund does not outperform a standard ETF, a passive ETF after fees. So people are saying, okay, well then how do I fund my company if there's less VCs, less money going into the space, and the structures that they haven't innovated in 20, 30 years? And that's what we think is crowdfunding. And in the crowdfunding space, we specifically think that foundations will play a major role, both from the venture philanthropy area and the non-dilutive side as well. Well, what is HealthiosXchange? So HealthiosXchange is been sponsored by Healthios. It is a premier investment marketplace and crowdfunding portal that has its mission as this, and that's to unify the promise of medicine with the fortunes of those who invest in it. In HealthiosXchange, and when you take a look at these slides, and we'll tie it in with venture philanthropy and foundations, but when we take a look at these slides, keep in mind 3 different systems. LinkedIn, due to its friending and following and community building, which is very important to foundations. The other thing is Angel List. Everybody's welcome. And then lastly, Match.com, even though it's kind of funny, but it's tagging data and matching investors with companies. So at its very core, HealthiosXchange was created to match emerging growth companies with accredited investors. It's also built for foundations to build relationships with large strategic partners and with venture capitalists, and to collaborate and on due diligence. So there's due diligence tools here as well. The portal can also be a viable area for foundations to expand their donor base, since many of the wealthy people that invest in the sector have philanthropic goals. As you'll see here, it's a very robust engine. You've got, we don't have yet, but soon to be 100,000 accredited investors in the portal, 9,000 institutions. Those are venture capitalists, family office, angel groups, strategics, foundations, 700 not-for-profits, 200 strategic buyers, and the emerging growth side, the company side, is building as we talk about. The HealthiosXchange seeks to transform the healthcare capital markets in 3 ways. It's here to expand the access to capital, it's here to enhance liquidity, and it's here to heighten IRR. It's a no-fee, no-carry platform. So when companies interface with foundations and VHOs, it's on basically they're allowed to come into the portal and build relationships. So investors have the ability to have direct access to companies, not through a fund. There's no adverse selection. Foundations can see all of the companies that are in the respective 46 market sectors, and there's other strict quantifiable due diligence methodologies. You'll see that we try to follow companies from seed to exit, which is really important because there's a motto about no orphans, no companies left behind. So we've got HX Crowd Finance, we have HX Foundation Place, we have Express, and In-Market. So we have a situation where we try to follow the companies from their earliest stages, crowd finance, which is non-venture backed companies, matching them with investors and foundations, through Foundation Place, which is the focus today, which is partnering with mission-based organizations to advance social good. Express, exclusive preferred emerging growth sponsored security, which is co-investments alongside the top institutionally backed companies. And In-Market, which is the liquidity portal, which is pipes at the market transactions and reverse mergers. And you'll see, this is just a placeholder, but you'll see some of the funding now, Formula, Savarian, AppleVax. So the key here is that we've got these 4 portals. We want foundations to be able to identify companies, to partner with investor sources, and use what we have a scoring system, which is helping us with due diligence. So there's 3 key pillars here. There's open access, everybody is welcome. There's a scoring algorithm to assist foundations with being able to evaluate companies with the highest probability of success, and I'd be more than happy to take questions on that. We also have a fee-free, carry-free model, which means no management fee and no carry. So those are the basic tenets of it. The crowd anchors the continuum. You can see there's a flow from seed to exit here. There's scoring and fee-free. We also, we populated this with 5,000 emerging growth companies. There's probably 5 to 10% that are curated actually by the company, and the rest are pre-populated and growing every day. There's actually 46 market sectors now in pharmaceuticals and medical device. So your search and evaluation teams will be able to identify companies in different market sectors, organized by ecosystem, transaction type, and customized. You can get a watch list, you can follow companies, and receive catalyst updates. The database will have 100,000 accredited investors to assist emerging growth companies with pushing forward their drug development efforts. And we also, in the spirit of the Match.com, the second point is essentially we have a fully integrated engine where we forward people to your site, to the emerging growth company. So if it's a foundation-backed company, we're trying to assist the foundation with capitalizing one of their current investments or holdings. We also have a very robust research offering. It's very highly quantitative, think Google, but their scoring system is based on taking a look at 2,000 companies historically with positive exits, IPOs, M&A, and licensing, looking for the variables that matter, and we have an algorithm that matches companies against some of those benchmarks. And we also have third-party research on the site. The scoring, non-venture-backed companies get scored on the site. 104 discrete quantifiable measures. You can see some of these bullet points. This is quantitative. The qualitative side will come with crowdsourcing, such as measuring patents and also the strength of the management team. So we'll rank companies from 1 to 100, and the top quartile will be able to post and fundraise on the site. And this is what a company page looks like. So you'll see it's very comprehensive. You've got the scoring up in the lower right-hand corner. And by the way, when you guys might have many questions on the site, and I really do encourage you to reach out to me via phone or email, which we'll send you the presentation deck for you to be able to do that, because there's a lot to explain here. But if you think about it, why should foundation-backed company executives be flying around the country looking opportunistically for capital when we can match investors online, we can lower the investment threshold so they can diversify, and we can put them in special purpose entities so there's not a fragmented cap structure. So you'll see in this company page, you've got fundraising targets over, and we'll start in the Northeast and kind of swing around. You have an Invest Now button, which is an electronic reserve system, which allows them to view the documents of the company in real time, go ahead and electronically sign and forward money into an escrow account. You'll see below the minimum raise, that won't be zero, that'll be more like 500,000. And essentially what happens is that when a minimum is raised, then whether that capital comes from a foundation, accredited investor, or venture capitalist, it doesn't matter. The money will be wired to the company. And by the way, our revenue model is we get 5% as a success fee. And then here's the maximum raise. There'll be a 90-day window. You'll see the minimum investments, pre-money valuation, use of proceeds. As we swing around to the left, you'll see highlights, Q&A, public documents, video. You'll have the opportunity to talk with management, take a look at the highlights of the company, take a look at the non-confidential documents, confidential documents with an NDA, and then in the lower right-hand corner, that's something real special. And in that case, what that is that the followers will get Catalyst updates on the page. So essentially, what happens is if you're a follower of this page, if anything changes in the portal itself, then what happens is that you will get an update either via email or you could get it many different ways. Text, you can get it LinkedIn. There's many different ways you can do that. So it's a Catalyst mapping system. Now, we encourage companies and foundation-backed companies to augment their site with team members, which is management, board of directors, advisors, employees, and colleagues, friends, etc., to follow the company. The more page views, the higher it goes. So that's essentially a positive from a social media perspective. The crowd does have an impact on companies and whether they do get funded. So that's a wonderful thing if you believe in the wisdom of crowds. But it is a quantifiable measure at its very core that really does dictate overall, not just the crowd. The crowd basically will, almost like Tumblr, vote up and vote down companies. We also have, for those in the portal, the ability to attend our offline meets online conferences, meaning we have 14 historical conferences at major scientific meetings, think Bio Partnering Forum. And you'll see here we've had a lot of activity over the last 6-7 years. And so, like for example, I hosted the one at ASCO this year in Chicago. And this is a way to actually meet with the leading strategics. In the ASCO meeting, we had 25 major strategics. We had 30 emerging growth companies. We had over 200 partnering meetings. So partnering is a major aspect of this process. It's a derivative of raising capital, and it becomes closer to financing a private placement each and every day with some of the option-based models that are out there. So that's a significant advantage of our platform being a fully integrated investment bank. From a conclusions perspective, we'd like to say that we put a lot of energy into designing just like the foundation of a house. It's only as strong as its foundation. And really what we came up with was the Kaufman study, which basically they had, 100 or so VCP fund investments. I think of those, I think it was like 12 or 13 actually gave them a 2 times return, and the majority of them barely returned their capital after fees. And they came up with these 5 recommendations here. And so we incorporated those 5 recommendations into the portal itself, which you'll see here. On the left-hand side are the recommendations, which we'll go through a few of them, and then you'll see the corresponding portals. The second one down, invest directly in a small portfolio of new companies without being saddled by high fees. That's our crowdfinance, non-venture-backed or foundation-backed. Co-invest in later rounds, that's Express or our venture-backed companies. Move a portion of the capital into the VC, into the public markets, that's in-market. And then, of course, you have to get rid of the fees. The fees are too high, and that's what prevents investors from benefiting and from companies getting their capital. One slide that I browsed over that's really important is here, which is essentially, here is the opportunity for foundation-backed companies. The fact is the majority of high net worth investors in this country do not have private equity investments. If they are in the alternative investment bucket, they're in oil and gas and real estate due to the fact that they yield and have an asset. So how do we change this? The way we change this is low investment thresholds. The reason why there are not more investments is there's no liquidity, and the other thing is they can't diversify because the investment thresholds are too high. The other thing is that angel groups are asking for dues, angel groups are asking for time, and it's not really the optimal. The other thing is there's a lot of wealthy people, not in Boston, San Francisco, that actually are not in the vicinity and thus can't join a group, which can be very problematic. The key here, the summary page, guys, is this. Foundation Place, what is it? It's for foundations. It's for voluntary health organizations. It's essentially built to do 4 things. That is, to help foundations and their companies do due diligence, both on the companies, on future investments. It's a place where you can access and prevent against adverse selection, meaning you're seeing all opportunities in the infosphere. You can raise follow-on capital. There's no way typically that a foundation can raise the capital for one company that's going to be needed to get them over the finish line. And then lastly, it's a really important community building area to build relationships with venture capitalists, with strategics, and hopefully if we're successful, guys, at the end of the day, it's to fund early stage companies to get new drugs approved so that we can, obviously, cure diseases and improve people's lives. So having said that, that's the conclusion of this webinar. By the way, my email address is sjordan@healthios.com. That's SJORDAN at healthios.com, and be more than happy to conference with you, to take you into the portal, to show you the foundations that are active, and we can go from there. So thank you so much for your participation. It's been a pleasure, and look forward to our continued discussions. Thank you.